What are the 4 reasons why now is a great time to buy stocks? So right now, obviously the stock market is down for the year, having hit record highs in January. And a lot of people are kind of worried about the situation and thinking, well, is this a good time to buy stocks? But here are 4 reasons why I think now is a great time to buy stocks. Number one of Warren Buffett's most famous quotes is be fearful when others are greedy and greedy when others are fearful. And what's interesting is so many people know that quote, but also few people, should I say, put it into practice. So for example, I can remember in 2009, 2010, a lot of people were worried about the Dow Jones going below 10,000 again. Now it's at like 30 odd thousand. And obviously, from a long-term perspective, it wouldn't have really mattered if the Dow went to 7,000 again or 9,000. Likewise, I can remember in late 2018, early 2019, again, there was a relatively small correction, 20 to 25%, and there was a government shutdown at the time, and a lot of people were worried about that. Or obviously 2 years ago during COVID and so on and so forth. And I'm sure a lot of people listening to this have seen literally tens of occasions like this. And even if you weren't born, as most of us weren't during kind of times like the 1950s or 60s or whatever, you can go on YouTube, you can look at these kind of times in history and then look at a longer term graph. So for example, the crash of 87 was an absolutely huge event at the time. But most people watching this probably either weren't born or were too young to have actually remember the crash of 87. It was huge. But if you look at it in a long-term perspective, it really didn't matter if somebody bought one day before the crash or indeed, after the crash, it happened. Probably the best recent example is the NASDAQ. Now, the NASDAQ fell 76%, yes, 76%, from early 2000 until 2002, a huge fall. But if somebody bought literally at the peak of the NASDAQ's bubble and kept until last year, they would have made something like 12% per year, despite a huge fall in the middle and taking 14 years to kind of recover. So at the end of the day, if you're willing to be long-term and invest in the stock market, the chance of you making a lot of money is extremely high. Not only is it extremely high, but it's never happened historically where if somebody's held the market for a very long period of time, the major markets like the S&P 500, Dow Jones, MSCI World, it's never happened once where somebody like that's actually lost money in the stock market. So in a way, now is always the best time to actually invest in stocks because nobody knows when a crash is going to come, when a correction is going to come, when the good times are going to come rolling. I mean, look at 2020, right? Nobody foresaw. I mean, if I would have said to you in January 2020, the stock market's going to go up 15, 20%, but it's going to be a huge 50% fall in the middle, but stocks are going to come roaring back after a pandemic and a disputed US election, people would have thought I'm crazy, right? So nobody can predict these things. So we can't say for sure the stocks have hit their bottom, but we can't say the stocks are just not going to skyrocket back quickly to record highs. And that shouldn't matter. You should just be focused long-term on the long-term picture for your account. Now that's one thing. But then secondly, we have to also remember that even though nobody can predict when markets will go down, if you do buy during moments like this, you're buying at a huge discount. Now, what do I mean by that? For the stock market, just to get back to where it was, that's a 20-25% gain in addition to obviously hitting new highs, which stocks always have. So think about it this way. If your favorite item in the supermarket was at, a special discount, you would buy it, right? Or likewise, when it comes to investing, if a house in the best neighborhood in your city was trading at, 20-25% down, you would say, wow, of course I would buy a house. A year ago or even 6 months ago, if I would have said to you, would you buy stocks if the market was down 25%? Most people would say, of course I would, because it's cheaper. But then the interesting thing is when something like this happens, actions speak louder than words, and people tend to not follow through because they read the media, they listen to their friends, and it's a bit of a herd mentality, right? People like to buy when other people buy, and they tend to sell when other people sell. But at the end of the day, future valuations always go up whenever something like this happens. So the Vanguard Group produced a study that was, I think, a year or two ago, and they said for the next 10 years, expect to only get 4 or 5% annual returns. But having said that, we can't predict the future. And in addition to that, if there's a crash or a correction in the middle, we'll have to increase those returns because obviously that resets the returns. when you've got a situation where those stocks have fallen by 20-25% and the Nasdaq 30%, that's actually reset future expectations higher, because in the very long term, the stock market is based on two things: dividend growth and profitability of firms. Jack Bogle, the founder of Vanguard, called that the real rate of return in investing over any 30, 40, 50, like very long time horizons. There is a correlation between the stock market and dividend yields and the growth of a company's profitability, basically, the growth of business earnings. And so at the end of the day, when you look at things like that as well, which leads me to another point, nothing has actually changed. I mean, if you look at the big companies, say Amazon, is Amazon making less money this year than last year? Are the biggest firms in America and the world going to be making less in the next 10 or 20 years compared to what they were expected to last year? Of course not. The most profitable firms are still giving either a dividend or they're growing as companies. So for example, at the start of the year, I wrote an article saying, well, nobody can predict what will happen this year, but if you look at the intrinsic value of a lot of those stocks, the US stock market, the S&P 500, should actually go up by 8 or 9% just because of the dividend yield and the growth in companies' profitability. But of course, nobody knows, because there's always speculation. There's a speculative return and there's a real investment return. So the point is, nothing intrinsically has changed. And that leads me to a final point, and that's that there aren't any obvious alternatives at the moment. Now, of course, there are certain alternatives. If you are close to retirement, you should have a diversified portfolio. You shouldn't be 100% in stock market indexes or the stock market forever. But if you're younger or even in early middle age, there aren't obvious alternatives. Cash is paying even less relative to inflation than it was 6 months ago. Yes, interest rates are going up, but cash is paying less. You know, if you put your money or leave your money in cash now, you're guaranteed to lose about 8 or 9% to inflation. 6 to 12 months ago, it was only 3 to 4 or 5%. So cash, as Ray Dalio says, is pretty much trash. And in addition to that, more currencies could actually go into a crisis, like the Turkish lira. Even developed market currencies, look at the euro hitting parity against the US dollar. The British pound could go into a currency crisis. I'm going to talk about that in another video. The Japanese yen has fallen off a cliff. Emerging markets could be really, really bad, not just Sri Lanka and Turkey and whatever. So cash is even less good than it was before, especially for anybody who doesn't have US dollars. And somebody who does have US dollars, you have to also consider, well, the dollar's getting stronger now, but obviously it's not going to last forever. So, being in dollars forever also doesn't make sense. Then real estate in the current environment is looking riskier than before, because you had big rises after COVID. Also, when it comes to real estate, interest rates are very sensitive when it comes to that kind of, purchase. So real estate isn't a bad investment if you're a professional real estate investor or if you just want diversification. But real estate is looking a bit more risky than, it has for a while. And real estate investment trusts, I'm quite a big fan of them. And I do think a lot of the commercial real estate investment trusts are worth 5 or 10% in your portfolio. But again, because more people are working from home still, they're a bit riskier than they were before. And government bonds, well, we've seen what's happened this year. They haven't gone down as much as stocks, but they haven't done what they historically have done. They have not actually gone up when stocks have gone down. The only ones that have gone up are the very short-term bonds, which are up just very marginally. So the ultra short-term bonds, which are like 0 to 3 months, I think they're up 0.3% this year. Which is even less than cash, and the long-term government bonds are down this year. So the point is, if you don't invest in the stock market, there aren't a lot of alternatives for people out there. So I would say, if you're long-term, you should always see this as an opportunity whenever people are fearful. If you're short-term, yes, you just shouldn't be investing in the first place, because as I said in the previous video, certain people just shouldn't invest. Because, for example, you have some people who say, oh, I want to invest for 1 or 2 years to save up for my marriage or go traveling or whatever. That is not a good reason to invest. Basically, investing is supposed to be where you've got money you don't need for the long term. Yes, you might have an emergency, you might have to liquidate it, but ideally, money you don't need, using it for the long term. And if you do it like that, it really isn't going to make a difference what price you buy at today if you're only looking to sell out in 2050 or 2060 for retirement. So if you've got a long-term time horizon, really you shouldn't be worried about things like this. And for that matter, there are going to be many more extreme moments like this. Imagine somebody who started investing like your granddad or something like that in 1950, and imagine how many peaks and troughs somebody like that has seen. If you're a long-term investor, you're going to have to get used to much more extreme events than what's happened in the last 6 months. What we saw 2 years ago during COVID was one similar example, but we're going to see a lot of ups and downs in the years ahead. But the market has always hit record highs historically, so there's no reason to panic.